Cashflow Chronicles. I'm here with Hot Chris, the man, the myth, and the legend. We are talking Snowflake briefly today, and then we've had a couple other people reach out about a couple other stocks. Who knows with what we'll get into, though, but I do want to take a quick look and look specifically at Snowflake. They gave some guidance all the way out to fiscal year 29 for them, which is 2028. And I want to see, just based off their current valuation of $58 billion, is the company, even on a fiscal year 2028 perspective, fiscal year 2029 for them, is it overvalued? The answer is yes. But we'll get into the numbers. And Chris, you noted that you did not have the opportunity to look at it, but are you still very bullish about Snowflake compared to Palantir, or what? How are you feeling?
I think Snowflake does better than Palantir long term for now,
Yeah.
but the
Long
things
term or
can
medium
change.
term?
Long term, long term. The thing is, look at Snowflake's growth rate; it's still good. Like, still way past Palantir's growth rate, unless it starts to reaccelerate above that 30% mark. You know, you're looking at a bubblish stock for Palantir. So just purely based on valuation. So we've got to keep seeing this with Snowflake to see like what their growth rate looks like. The other thing is I'd probably keep my eye on someone like Altimeter Capital with Brad Gertzner, see what some of the changes are with his portfolio allocation, because I think he has more insights on how the company's planning on growing even more going into the future. So if I start to see Brad Gertzner start to sell out of this position, and it's one of his largest position, I'm probably going to take a second look and say, what am I missing here? Because there's so many things about this company that are still like an X factor.
Right.
I think that one of the key things, differentiators, is going to be their venture capital arm. That's not necessarily like recorded in the current valuation model, but we'll see.
Yeah, I think we'll get a little bit into how the revenue has been slowing, but I think that's just the rule over large numbers, right? But even still, I'm curious to see what your thoughts are, because it is slowing down. It's not as slow as Palantir, so I'm just going to throw that right out there. But in terms of what they're forecasting over the next 5 years, it's kind of surprising. So I kind of want to get your thoughts into it. So let's top into some of the numbers. So keep in mind that this particular quarter that they're reporting is their Q3 for fiscal year 2024. So they're a little bit strange, kind of like Microsoft, how they're in the 2024 range. So these guys, for fiscal year 21, 22, and 23, they had revenues of 592, 1.2 billion, 2.1 billion. And now they're kind of on pace for 2.65 billion in the fiscal year 2025 quarter. Their run rate at the moment is about 750 million per quarter. So it's pretty significantly ahead of, say, Palantir. Palantir's fiscal year 2023, so the same year that we're kind of reporting against Snowflake, is looking to be about 2.1 to 2.2 billion. So overall, you're looking at about 20% more revenue coming from a Snowflake in this particular year than we are for Palantir. And the growth rate is about double, right? So this particular quarter here, looking last year in Q3 of 2022, or they're calling it Q3 of fiscal year 23, they're seeing a 32% revenue growth from 557 million to 734 million. This is all just, jumbly gook, and, does it actually matter? Let's get a little bit deeper into some of these numbers. They're almost 9,000 total customers. Their Forbes 2000 customers have kind of flatlined. They're still at about 30% of all Forbes 2000. So there's that. Their customers with over $1 million of product revenue has grown by 50% year over year. Net dollar retention is slowly on a decline, but much better than Palantir, 135% rather than the 109% that Palantir just provided in the most recent quarter. And their gross product margins are increasing as well. They're up to 78%, but still below what we have for Palantir, which is like 81 to 82%. Non-GAAP adjusted free cash flow is at 15. Palantir is in the 20s, so they are kind of behind in terms of comparing that to Palantir. and their focus on cash flow generation is also slightly behind Palantir. But I think from a cash flow from operations perspective, I think Snowflake might be winning. I think it's just the fact that Palantir has so much cash on hand, and they're generating a decent amount of treasury income that might be why they're slightly ahead. But they're kind of neck and neck overall with the cash flow generation there, and they have quite a few more employees, 6.5, almost 7,000 employees there. The things that I wanted to get into are kind of here. So the year over year product revenue growth was just a few years ago 120%, 106%, 70% last year. And from last year to this year, they're going to be about 37%. So they are slowing down, but that might be the rule of large numbers, just the fact that you're getting larger and larger in terms of
I think it's more important to look at the operating income. That's the thing that always interests me. If your operating income's growing, that means that you're getting more value from your shareholders. So
yeah.
The fact that they're able to monetize at a higher rate, that's good. So go ahead. Sorry.
So no, that's a really good piece in there. So they're forecasting about 7% ops margin. So off of this, they're kind of expecting, what is that? I'm not very good with math. You guys know that. 2650 times 0.07. So expecting about 185, 200 million in terms of ops margin that they're going to be kind of creating from the company. And now, of course, when you look at it on a GAAP basis, this is something I'm going to dive into because these guys are giving out 3 times as much share-based compensation as Palantir, and we already know how bad of a problem Palantir has. So on a GAAP basis, these guys are still largely unprofitable. But that could be, always kind of going back to the fact of, well, what does it really matter, right? If you're building cash in the company, that might be more important than, being a GAAP profitable business. But anyway, just some food for thought there. And then adjusted free cash flow on a non-GAAP basis is about 27%. So this is for this year. So they're a quarter away. So they need to kind of generate another $750, $800 million to hit this target and get to this kind of 7% non-GAAP operating margin. But the thing that really triggered me to start doing some math was this $10 billion approximate fiscal year 2024 target. Now that's
2029.
Sorry, thank you. The 2029 fiscal year target, which is our 2028, their 2029. So 5 years down the road. So my thought process is what compound annual growth rate do you need to be able to go from 2.6, 2.7 billion to 10 billion in a matter of 5 years? And the answer is 30.5%. So my thought with that was, well, you're already slowing down this year to 37%. What kind of reacceleration are we expecting when we get into next year for this to continue at that pace? Because I doubt going from 2027 to 2028, they're going to continue to see 30%. That'd be pretty impressive. So I anticipate that they're in forecasting they're going to get back to 45, 50% revenue growth rate next year, and then possibly slow down from there to be able to hit that $10 billion target. But another piece that I wanted to look at is the non-GAAP. So this is before share-based compensation, 25% non-GAAP operating margin. And then the adjusted free cash of 30%. So let's just break this down. $10 billion in revenue, that's about $2.5 billion in non-GAAP operating margin that you're getting, and then about $3 billion in adjusted free cash flow. That's before share-based compensation. Now, hopping into this a little bit with some of these numbers, this is where it gets a little tricky, so I apologize. Let's just see. Where is all share-based compensation? Okay. Sales, marketing. That's just them. That's just them. Okay, so here's all share-based compensation for the entirety of the company. It's about $300 million per quarter that we've kind of observed over the past 4 quarters. So you could say it's anywhere between 250 to 300. It looks like, just based off the fact that the company's grown a little bit in the past few quarters, that it's hovering around 300. So let's just say it's 1.1 to 1.2 billion dollars in impact on an annual basis for now. So if you look at this, go back to this graphic here. Are you following me, Chris, or am I just talking a lot of numbers?
I'm following. Okay. I'm following.
Okay. $10 billion top line, right? 25% operating margin. So you're walking away with $2.5 billion in operating profit, right? Take $1.2 billion away from that, and that's going to be your GAAP operating margin, basically, of, I would say, about 12 to 13%, because you're taking about 1.2 to 1.3 billion away in terms of share-based compensation. So if you're thinking about that, you're left with about, let's just call it even 1.5 billion in operating profit. The company's $58 billion today. You're looking at, just based off of that, 58 billion divided by, let's just say you're left with 1.5 billion in operating profit. Looking at a price to earnings, or price to ops profit, I guess, EBITDA, whoever, whatever you want to call it, of 38 times. Not in today's guidance, not for fiscal year 24. What we're looking at for this year, 2.6 billion in revenue, 7% operating margin on a non-GAAP basis, 27% adjusted free cash flow margin. You're talking about 5 years down the road, after an annualized 30% compound annual growth rate, and you're still looking at a 38x in terms of ops profit. To me, this company is very, very overpriced. I don't know if I'm just throwing smoke or if I'm trying to put mirrors up for you, Chris, but I'm really curious, does that make a lot of sense?
I wouldn't buy it. I wouldn't buy it at this price. No, I'd probably hold back. There's going to be other parts of this target that are going to be revealed, I think, over the next few years. So yeah, I think right now buying it today, you might be a little bit overvalued, like paying a lot. It doesn't even fit the rule of 40 right now because of all the slowdown that it has. So in my opinion right now, I just wouldn't be as enticed by their guidance. But then again, there's other parts to this business that we may be missing. So we probably have to do a little bit bigger of a deep dive. I hate relying on just these numbers. I'd rather speak to people within the industry to see, okay, like what kind of other products are they likely to upsell? What are some of the things that they could integrate into their business model that they could utilize to, grow their business and then grow their side businesses? Mm-hmm. And then also, they are running a venture capital firm on their balance sheet, which could pose a lot of synergistic benefits later on. So, let's take a step back from just looking at the guided numbers and see, like, okay, what's the true valuation of this company, and like what are some of the intangibles that we're not seeing? Because I'm seeing a lot of big time Wall Street people in this company, and the fact that they're remaining in this company leads me to believe that there's something there that we may actually be missing. So we're looking at the raw numbers, but let's like I said, let's look for some intangibles that we may.
So do you think Slootman is sandbagging? He has to be, if that's kind of what you're saying there, right?
I wouldn't say sandbagging. I just say that he's painting a target that it's something that you can easily meet, but he's not exactly putting out some of the other things that may be out there. Remember, there's also acquisitions that the company has made that they could readjust a lot of their calculations on in the future. So I'd say this is good to take a look at it in just terms of, like guidance, but there's X factors in there. And I feel like it's a disservice to do guidance this far out.
Yeah.
In my opinion, because you don't know what the world is going to look like. You don't know what the technology landscape is going to look like. It's nice that a CEO wants to give this kind of transparency, but I don't know. I'd take a second look.
Where I would say, thank you for the 5.99 super chat. That's much appreciated, Pisash. What I would say though is, I'm doing it a service by even having this conversation because I haven't even listened to the conference call, and
Exactly.
there could
I'd
be
say
some
so.
great insights. But the thing that confuses me is the call that I heard in 2Q is not what showed up, which obviously is why the price rallied after hours. I
Yeah.
think that they were still painting some sort of dismal kind of rest of the year, and they ended up, beating that expectation because they're up, 7.5% after hours, up to $188 per share, $58 billion market cap. So my question, I guess, is just,
Let's do more
I,
research before we
yeah,
talk about it. Let's do more research. That's
yeah.
it. Because if it's nice that we want to comment on it, but unless we hear the conference call, we understand what's going on. We see some intangibles. I don't, like I said, all we're doing is just talking about the general numbers, and I don't think it's going to help.
Yeah.
So
So I
yeah.
mean, what I do want to hear about though is I mean, obviously Palantir is a competitor. That's obviously overpriced as well. What are your thoughts on other competitors in this space?
A lot have been rallying pretty hard. It's nice to see because it's a wake up call to a lot of people that are in the SaaS business because they're just so important to the general functioning of Silicon Valley. You kind of want to see that, but I feel like we are hitting points where right now valuations are starting to get a little bit stretched again. But let's answer that super chat real quick, if you don't
Yeah,
mind,
agreed.
just to get it out the way, because I think that person. Sorry, I didn't address your super chat in the last podcast because I think they put the same thing. So,
Oh, I didn't even see.
including. Oh, there we go. Yeah. No, it
Yeah.
was on Finance Junkies. They asked the same question.
Oh,
So
okay. Very good.
I would say of the CEOs, the mega cap CEOs, my number one pick in terms of capital allocation and running the business is Hawk Tan from Broadcom. Like, the guy's a killer, man. He's amazing. Like, the things that he's been able to do are just on another level. Number two, I would probably put Nadella because Nadella is the same thing. He understands capital allocation better than anyone else. Number three would be a tie between probably someone like Lisa Su and Musk. Lisa Su really turned AMD's fortunes around. She understood the value of the core architectures, like how to basically do the architecting that was necessary and do things on a timeline and how to run the business. So one of the great things that she did was she gave up the foundry business on AMD and just focused on designing chips, which was great. She cut through a lot of that stuff. Musk, of course, is the innovator. He does have some challenges when it comes to some of the politics, I guess, now, but he's still an innovator. And Cook is the master of logistics. The only reason I put Cook at the bottom is because I don't necessarily see a lot of innovation out of
Yeah.
Apple these days. But Cook is really good too. I mean, all the people that you've put on there are just like they're awesome, And so, believe it or not, Sundar Pichai is pretty good too. But the problem is Google has a culture problem, and I don't know if Sundar Pichai is strong enough of a leader to bridge that culture that's been kind of ingrained into Google over the last like 8 years, where they've gotten a little too comfortable. They've done a great job of being able to monetize the crap out of things, but they got comfortable.
Right.
And now to get to galvanize the employee base, get everyone back into like fight mode. I'm not so sure Sundar Pichai may be the guy to do that. So I don't know.
I'm curious, why are you putting Elon not at the top? You put Satya ahead of Elon.
Because I think from capital well, first of all, it says megatech CEOs. I don't even I don't consider Tesla to be that,
More of
like,
an industrial.
yeah, I think of it as more like a really great industrial rather than just a pure tech company, because most of the
Okay.
products that they have are more focused on, like, more industrial things. So I'd say he's more of an, and he might even agree with that, where he's like, I'm an engineer, rather than I'm a techie. The
Yeah.
other ones
Yeah.
are, the other people are techies. So if you look at it, it's a false equivalence to kind of put together someone like, I don't know, someone who's more on like developing a business around software rather than developing a business around a integration between software and hardware. So,
Okay.
yeah.
Interesting. Yeah, I don't necessarily have too much of an opinion. I mean, I know the thing that I am most surprised about. I mean, I won't necessarily answer that question because I just don't think I can speak to it as well as I probably want to, just because I'm not maybe as familiar with all the different investments or all the different segments of the businesses that some of these CEOs were a part of prior to becoming CEO. I mean, I know Satya was part of the cloud business, and he obviously took that and pivoted Microsoft completely to the cloud piece. And I know that's what Andy Jassy did as well for Amazon, and so he's done a relatively good job associated with that. But I don't know. I'm just trying to think in terms of would I disagree with anything that you said. I mean, I like the response that you gave for Elon, and that's more of like a. And the thing that with Elon as well is he almost, from a capital exposure perspective, scares the shit out of me. He's just gotten extremely fortunate, and I think that part of it is his gusto, and part of it is just luck, right? I mean, he was a launch or two away from bankrupting SpaceX, so I think he's just gotten really lucky over time. But at the same time, he's been able to maneuver himself and put himself in the right place to make the right decisions.
Yeah.
But I don't know. It's a good thought. I'm not 100.
A,
percent
a, a good question is, should you sell out of Google? In my opinion, no, because Google's valuation is so low right now, and the amount of cash that they generate is so high that even a moron CEO could see this company bring tremendous value to shareholders.
Yeah.
You just have to remember that, where is the business in terms of like profitability, cash flow? Sometimes you don't need a innovative CEO. Sometimes you need a caretaker CEO. You ever notice that there's
Yeah.
different types of CEOs? It's almost like a tool, right? Like each tool has a separate function. So like you go to Lisa Su. Lisa Su was the turnaround person. Like she understood the business. She turned the business around. Tim Cook was the maintainer and the guy who like really did a great job in taking Apple from its strong position and making it even stronger. So he's like a caretaker CEO. Sundar Pichai is also a caretaker CEO. So yeah, each one of these guys is different. And then Zuck is a ruthless, maniacal, like innovator. So I would
Right.
say, I believe in Zuck over the long term in terms of getting shareholder returns. The only thing with Zuck right now is that in the court of public opinion, he's really like just, I don't know why people hate him so much, dude. Like, I don't know. Yeah.
Yeah. I mean, I think it's the whole thing. The whole thing with Google. Would I sell it? I'm with you there. Absolutely not right now, because I still think there's so much tailwind in cloud, and that's just getting to a point where they need to live that out. It might be in 2 to 3 years' time if they don't continue to meet any sort of innovation and they start falling behind in that respect. They don't fix their culture, which is sometimes takes 10 years for it to really be like, oh, this is really that toxic. You start literally, what's the word I'm looking for? Not festering, but I guess it's like completely rotting from the inside out. You've seen that at Twitter. You've seen that at a few other companies where they just completely get so culture like negative that it ends up absolutely destroying the company. But anyway, I think that there's a few years before Google really has to become a ticking time bomb for it to be a sell. And I think a lot of it is, you really have to get to a point where, like, um, think about when Amazon's AWS started to become profitable, and think about when Microsoft's Azure started becoming profitable, and how much additional net income the company started to generate. And that's literally where Google is right now. And they're going to get literally, probably close to $10 billion in the net income space within a few quarters here on a rolling basis. And that alone will probably add $200 billion of market cap, let alone if it continues to grow at a pretty expansive rate. I guess if they just keep their margins up, then that's all that really matters for that one.
Yep.
I don't know.
Yeah.
Uh,
No. Yeah. Go ahead. Sorry.
well, I was going to ask. I had somebody message me earlier, and I'm wondering if you've done any research on CVS at all.
Not really. I try to avoid anything that has
Me too.
exposure to retail right this minute, only because there's just so many challenging things. You've got shrinkage issues with people stealing, so that's number one. Number two, you've got issues around competition from the likes of like Amazon and
Yeah.
stuff like that. So that's another factor. Labor costs are going up and through the roof.
Yep.
So you already have you already have a business that survives on really low margins. So the question is like, how do you continue? So I just don't see the value, but maybe I'm missing
I
something.
don't disagree with you, right? So my initial thoughts were just that. And I guess my reason I bring it up is because I was scratching my head because I had a group of people being like, they're more value oriented investors. And so I looked at their investor presentation, and just like you expect, their front store sales declined by 2 or 3%. I don't know if it was on a sequential basis or if it was year over year basis, but regardless, store sales declined over the past 12 months for sure. Right. So that obviously gives you a little bit of like, okay, why would I invest in a company that is called CVS? Because they're a convenience store, right? That's just an abbreviation of convenience store. But the fact that it seems like they're on the brink of rebranding themselves, and hear me out, right? Because this is something, and I'll dive into the numbers here in just a minute. It started to dawn on me that it's like they're leaving almost the convenience store piece of their business behind. They have Aetna insurance. They have all these healthcare pieces that they're trying to get out. Their pharmacy sales are strong. What if I told you that CVS's EPS grew by 10% year over year in this last quarter? Would you be surprised by that?
I would be. I mean, what did they do? A lot of share buybacks or
I don't know. It gives me a little bit of a thought to like actually look. It didn't look like they did too much in buybacks, but let me just paint some numbers for you. It's an $87 billion company, which is huge considering that it just sells convenience store items, right? You would think that, if you were comparing it to say a
I mean, it's also
7-Eleven.
got a farm. It's also got a pharmacy,
Yeah,
and
yeah, yeah.
I think
But
they also own their own PBM. But
I would expect that it's more of like a $50 billion business. But the fact that it's $87 billion was kind of a head scratcher for me. How much cash flow from operations do you think that CVS is going to generate this year alone?
I don't know. I haven't even looked, but I think the key to remember here is that they also have a giant PBM business, which makes a crap ton of money.
What's PBM?
So
Sorry.
it's a pharmacy benefit manager. So basically, like companies contract out these middlemen services to basically do like price negotiations on drugs. And so what happens is they get a certain portion of the cut in between. So they're like the middlemen. So let's say Pfizer comes out and says, "Hey, this pill costs $1,000. This medication." Um, PBMs will do the negotiating for the insurance company and the manufacturer to say, look, $1,000 is not going to work. Like you have to give five, you have to, if you want coverage in the formulary for this specific company, you need to give them a discount of about 50%. And so this will only cost them, $500. And so what happens is based on the discount that they end up getting, they get a piece of that. So every time a drug is sold for $500, the PBM says, "Hey, I'm the one that got you that $500 deal. You got to give me a cut." And
Mm-hmm.
so pharmacy benefit managers work between they're like the middlemen between the pharmaceutical companies and the insurance providers. So that's what
Mm-hmm.
it is. It's called
So what if
Caremark.
I were to tell you that they're gonna make approximately $13 billion in cash flow from operations?
I wouldn't be surprised by that. PBMs are super profitable, so I wouldn't be surprised by that.
So knowing that it's like a price to cash flow from operations of like 6.5 to 7, does that surprise you?
I mean, I'd have to look at it more.
Yeah.
Like I said, the PBM business is the one that I would be most attracted to rather than the retail footprint. So that's something to see. But that's also there's also legislative risks too when it comes to these PBMs because as far as I know, that there is a lot of talk in Congress and everyone else to try to like limit the ability of PBMs to negotiate. And I'll tell you why, because they are a corrupting influence on how drug pricing works. Because, just like I said right now with you, they make their money on the ability to get a discount for their customers. So that $1,000 drug that they were able to get for their insurance carrier for only 500, they have this perverse incentive now to tell the drug manufacturer, hey, why don't you raise your prices to 2,000 and then charge the insurance company 1,000 and say, look, I saved you $1,000, so you need to give me a cut of that. So if the negotiated rate is like, let's say 5% of this total savings, so if they were able to get $500 savings, they would get, a piece of that, a 5% of that. But if they were able to get you $1,000 in savings, they're going to get a higher cut from that. So it's this perverse relationship. And that's like one of the reasons why drug prices are just, when you look at like the list prices, they look crazy, crazy high. They're like, what do you mean this drug is like $10,000? Like, how does that make sense? And most of the time manufacturers are not making $10,000. They're making
Mm-hmm.
five, or they're making four, or even sometimes two. And then you have these PBMs telling them, you need to raise prices so we can give a better discount. I know this, I know it sounds really fucking weird, but
No.
it's a practice that I'm not a fan of. And I think that it's eventually going to get legislated away. So just keep that in mind. Sorry, go
Yeah.
ahead.
No, no, no. I just wanted to kind of like bring it up because I was completely blindsided by this today when somebody started kind of noting this. So just to give everyone some color, the current stock price is $67. And if you look at what the fiscal year 2023 EPS or adjusted EPS is going to be, it's like going to be like around 750 to $8 on a GAAP basis, or it's going to be 850 to 870 on a non-GAAP basis. And to me, it's like, Jesus, you're looking at a price to earnings of less than 10. Like it's pretty impressive. And to be growing revenue at a 10.5%, and that's inclusive of a shrinking front store, convenience store business, which we'll get into in just a second. Like it's pretty crazy to see how they're kind of rebranding themselves. And I'm curious how, because they're in about 4 or 5 days, I think on December 5th next week, maybe that's a Monday. Maybe it's a Tuesday, I don't know, but they're going to have an investor day, and my thought process is they're probably going to rebrand, or at least try to step away from the CVS brand, which is the convenience store piece, and they're probably going to focus more on the healthcare piece. Probably because margins are higher, probably because the retail piece is being eaten alive.
Well,
Um,
there's this push to do more services in pharmacies, basically, where you could go get a shot in pharmacy. I think they might even be integrating something like a healthcare provider within the pharmacy itself. Because the benefit to these guys would be that they can push their providers to push a certain set of drugs on the consumer, and so that could end up being beneficial. So if there's, let's say, a generic drug that's out there, these guys could probably launch their own generic and make more money because you're being, I don't know, there is a lot of perverse incentives in the healthcare industry to basically profiteer, and these guys are probably at the center of it. So, you know, I'd say we'd have to look at a little bit closer. Me, I just look at them and like the impact of their retail footprint and all of these things. Let's keep going. Let me see if they actually describe any of the stuff that they
with
have in there.
peace.
Yeah, see, they don't really talk about it much. They don't really put that out there.
What, the
Yeah,
front
front
stores here?
stores.
I haven't.
Yeah. No. That's front. That's fine. I'm saying on the what is that thing called? The money that they're making on their other side hustles.
Oh, they have everything, man. I mean, here's a consolidated piece.
Right.
Um, here's the piece that's specific towards healthcare benefits and looking, from a Medicare, individual exchange, commercial products,
There it is right
government.
there. Yeah, there you go. That's the thing. So that's where, yeah, the medical membership number is growing. That's where all that cash flow is coming from. So they're getting more people signed up to their PBM. You see that with government and commercial? Those are independent lives that they're covering. So basically, what happens is when you have more lives covered, you're going to be able to monetize them at a higher rate. And so that's why they're making that's where you're seeing the growth in CVS.
Okay, interesting.
Yeah.
Because I mean, the thing that I guess was a little bit confusing to me, I guess, is revenue is going up pretty substantially for this piece, but the actual income's going down, and maybe that's just a temporary blip. I don't know,
Yeah.
but
Like I said, these guys are the fucking parasites sitting in between the healthcare system. Like I said, I don't know if I could invest in them just on ethical grounds. I feel like initially the goal of PBMs was to help save people money, but they've transformed into this money making operation. That's
mhm.
just, I don't know. I like I said, I'm not a big fan. I'm not a fan. So
Interesting.
yeah.
All right, well, we can leave it there. But I just wanted to like kind of bring that up because I was just like really surprised. I mean, that's part of the reason why I sold out of Realty Income was because CVS's retail fronts, and it could very well be that they shrink, right? And they
Hmm.
focus more specifically on, let's just say, a streamlined retail space store, and they expand sort of their health clinic piece. Because I have seen across Houston a lot of individual health clinics and private health clinics opening up, and I know when people, generally speaking, get like a sore throat or something like that, they want to get a test, they get a CVS or Walgreens. And I know that
Yeah.
those are, I've done that before personally as well. So I'm curious if that's really the avenue that they're going to start seeking, because you can kind of
Well,
get a standard at a CVS or Walgreens versus if you just go to a mom and pop private healthcare center, you don't
one
necessarily
of
know what you're
the
going to get.
one of the things I like is this right here, which is Amazon's pharmacy, where they sell a lot of medicine at pretty much at cost rather than, putting on all these additional bullshit things. It's crazy, like to see just how much things are marked up when you go to like the pharmacy versus if you just did cash payment. And so like there's a lot of disruption happening here. Yeah, it's just, yeah, we could talk about it another time because this is something that requires a lot of in-depth research.
Hmm.
But there's a lot of push to do more like mail-in order pharmacies and this other things to help reduce down the overall cost of healthcare. But for the longest time, these PBMs, man, I'm telling you, they're like a they're a giant parasite sitting on our healthcare system, basically just being the middlemen, extracting value between patient lives and believe it or not, even the pharmaceutical companies. The pharmaceutical companies hate them too.
Mm,
Do you know have you ever seen their business model visualized?
no,
No, let me show it
no,
to you because
I
I
haven't.
think it'll open
Yeah,
your
feel
eyes.
free. I mean, educate me, please, because like I initially, because like for example, when we went to Vegas, I was getting some gifts for Jeremy because we were going over to his house. I didn't want to show up empty-handed, and
Right.
so I went to CVS, and it was just like anything. Like if you just wanted to like even get like a Red Bull, you needed to call somebody to come get it out of the case for you. That's a joke, but anything that you really wanted that had any sort of substance, you had to get a get get somebody to help with you.
Yeah.
Anyway.
Okay, so if you look at here, right here, this is the PBM. Okay, like CVS, Caremark, there's a few, um, but they sit right here in the middle of everything. Okay, so you as the patient, you go to your doctor and say, "Hey, doctor, I'm feeling blah blah blah." You get a prescription. You What ends up happening is the pharmacy does the filling of your medication. So you get the medication filled by the pharmacy. If there's a copay, the copay will collect. They'll collect your copay. What they do is they submit a claim to your insurance company, and that goes to the PBM. The PBM says, "Hey, listen, this is bill Billy Joel showed up. He got this drug from us. Give us the money minus the rebates right here, and then the healthcare plan will end up working with the, what is that thing called, with the PBM to get them paid. The manufacturer negotiates what the rebating prices are with the PBM, because usually that's what the PBM's job is, to help lower the cost of drugs. But most of the time, the PBM's rebates are based on a percentage on how much money that they can actually save. So it ends up being that that they tell the manufacturer, raise the prices so we can give higher rebates so we can make more money, and then it goes from there. And sometimes they'll have their own specialty mail-in pharmacies, where the mail-in pharmacies is owned by something like CVS, where they'll send the prescription to them, and then they'll send you the medication directly to your home, you know. But you see how they're sitting in the middle, basically directing all of this traffic. You know, they're extracting a crap ton of value from that. And so, like I said, these PBMs are, when you go to the pharmacy, you're not like, the pharmacy doesn't buy the medication from the drugs directly. There's no like tie in to these two. It's usually like this whole negotiated dance that I think it's corrupt as fuck. But that's exactly why here in the US we pay so much for prescription drugs versus the rest of the world.
Yeah.
You know. So
yeah, well, I'm out. Like, I originally was going to go into the healthcare space, and I just never ended up doing it, and I ended up going into oil and gas engineering instead. And so I didn't have any expertise, but my knowledge of all that space has kind of gone out the window. And all the regulations that have happened since Obamacare came. I mean, it's just a little bit different comparatively to what I was kind of used to growing up. And anyway, it's a different world. I'm not 100% certain on a lot of that stuff anymore.
Yeah, and here's the legislation that could really screw with them. It's called the Pharmacy Benefit Manager Transparency Act of 2023. Right? PBMs are intermediaries that negotiate and manage prescription benefits on behalf of health insurance companies. Blah, 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 blah. Currently, 3 PBMs control 80% of the prescription drug market and operate with little to no oversight by federal regulators and out of the view of consumers. PBMs influence prescription drug costs, determine which drugs are covered by an insurance plan, and pocket unknown sums of money that might otherwise be passed along as savings to consumers. This lack of transparency makes it difficult for the public and regulators to fully understand how the market drives up costs for consumers. You know, so like I said, even from a legislative standpoint, there may be some intangible risks that are associated with this, and that's probably why, even with good numbers, CVS is getting its share price, killed a little bit. So this is where it really does come down to knowing the industry outside of just the general numbers, because if there's legislation that comes and sticks it to them, then you got a problem. So yeah.
No, I always appreciate your insights, because I know you work in the healthcare space, so you definitely know way more about it than I do. So interesting. So I'm curious, is there any other stocks that you're kind of looking at going into December timeframe? Or do you feel like I know you kind of said in Finance Junkies, I was listening along, they think 2024, there might be some sort of recession. The consumer is a little bit weak. Do you think that that's going to happen prior to 2024? Do you think we're going to have a Santa Claus rally? Where are you positioning yourself between now and when do you think this recession takes place?
To be fair, the data is pointing towards a weaker consumer. I think a lot of people are trying to front run this market and trying to say, oh, well, the lower rates are baked in now, and we should all be buying now and go into like the riskiest pools. Like, I don't know if you saw the market today, but FANG was down and all the meme stocks were running, so it's the return of the retail shareholders, baby. So I don't know. Like I said, I'm going to be correlating a lot of like decisions based on what I'm seeing in the market. But I will say this, I think we are headed for a lower interest rate, disinflationary and deflationary environment going into 2020, 2024. So I'm positioning the portfolio in order to capture those gains. So let's bring up our model portfolio and we can just quickly take a look at that.
Sure. Let me just get a quick screenshot of it here.
Yeah, like an example of TLT, right? TLT, there's no business behind it. It's just the value of the long bonds, and those are just getting bought up right and left as the 10 years collapsing.
Oh man,
So
it makes
yeah.
me sad because middle of the day, I looked at it earlier today,
Mm-hmm.
and we were looking hot. We were over 700. We are no longer over 700. But let me get.
I'm sure. I'm sure once the dividend payments come in this month, it'll get up over the 700 mark.
But we're up, man. Sorry, I'm just
Well, that's
have to
because
hide.
This is the problem with TQQQ, man. TQQ is probably what took the biggest dive today, because so much of the Qs are based on the mega cap tech. So when mega cap tech takes a hit, so does TQQQ.
Let me just hide my personal portfolio, all this other stuff. All right. Let's just see. Window. Here we go. All right. Let me know if you could see appropriately.
Yeah.
TQQQ, did that get hit that hard? It didn't. It was only down
No.
1/3%, hot, Chris.
No. You said it went to 700 and then it came down, right? A little bit.
Oh, okay. Sorry.
So
I
if
know
you
what
look
you
at
mean now.
midday, TQQQ was probably up high today, and then it probably came down to, so intraday, that's probably why you saw that intraday high, So if
Yes.
you, so if you
Yes,
look
you
at in
are
the
right.
morning time, TQQQ was trading at around 40, what is this,
Almost
45,
46.
69?
Yeah.
Yeah, that's
Yeah,
probably
that
why.
came down. When that came
Yeah.
down, yeah.
Yeah.
Okay. Well,
So you see the continuous look at our Dutch bro. Ooh, okay.
what
What's
did I
going
do?
on? What's going
I'm
on, man?
I'm trying to find my trying to find
Yeah.
my Cashflow Chronicles.
Ooh,
The StreamYard. There we go.
gotcha.
Sorry.
That's all good. Yeah. Which one is this one? DNNGY?
That's Orsted. So that's
A new
an
position?
offshore wind company that's been massively hit. I think due to interest rates, and I think that they're probably going to be a good one long term. But they're the number
Okay.
one offshore wind energy producer in the world.
Yeah, we should take a look at that. I think as we transition to cleaner energy, the businesses like that are going to do well. One of the themes I've been looking for is just with so many EVs coming to market, how is that going to impact the electrical grids? Well, that means that we're going to have to produce more electricity. And if the goal is for carbon-free energy in the future, you know, these companies might end up doing well. So, but overall, let's just looking at our portfolio right now. Our Crown Castle's been doing amazing.
Yeah.
Verizon's doing good. AMT's doing good. All of those are dividend payers, by the way.
Yeah.
I'm telling you, 2024 is going to be the year of the dividend stocks that got hit because of high interest rates. And as interest rates go down, there's going to be a yield chase. That
Yeah.
is my theory, and that's where I'm positioning the portfolio. Where if I see like there's some really mature businesses but have like strong cash flows that can support their dividends, dude, I mean, look at Verizon right now. Verizon's dividend, even at today's prices, is close to 7%. 7% on a cash flowing business. That's just, I don't know. It doesn't make sense, but whatever. If the market wants to be rational, I'll take it. And then TLT is up about 4.5, almost 5% since we started this, which is really good because TLT is a very safe place to park your money, and
Yeah.
so you're still getting a dividend for
We
it.
bought half a
And
share at TLT this morning, one share of Verizon this morning. What's gone, Chris?
huh?
What's gone?
Disney's gone, baby.
That's a shame. But we
Yeah,
made some good money. I think what was it, like 5-6%? So
yeah.
I just think that there's still potential downside. I just think that there needs to be a quarter or two. And I feel like the capital exposure right now for Disney, I feel like in a quarter or two might you might know a little bit more about how much at risk and how much longer it'll take. So I think this is going to be something that in 6 months, I feel like the price isn't going to change all too much. And I feel like you're going to end up being in a better position to make a decision as to whether or not you want to enter the company. I think you're right. I think in the long term, Disney with its brands will continue to do well. But you hit the nail on the head with respect to, is it the right opportunity at the right time, and coupling it with how they're trying to mess around with people. I know you guys talked a good bit about that on Finance Junkies. Kind of gives you that weird feeling about investing in the company,
Yeah. I have to do more research on nuclear. Like a few of the people that follow me on Patreon, they're really bullish on nuclear. And like, I've been meaning to do more research, but I've just been so damn busy doing all these things. So I definitely
Which
have to
ones
do more
they
research.
specifically? Southern Company, Duke, which one?
No, I think they're uranium suppliers. So like CCJ, Cameco, I think that's what it's.
Oh,
That's
okay.
the major one that I've been looking at. But if you look at my screen, let me just share it real quick.
Yeah. Yeah, Cameco
Uh,
has like Cigar Lake. It's like I think it's Cigar Lake. It's like one of the
yeah,
biggest. Um,
yeah. Look at this. It's up almost 300% in the last 5 years. It's from $9 all the way to 44 in the last three
yeah.
years. So I have to see what the dynamics on uranium pricing look like and why it's up so much, and just do a quick fundamental business analysis and then go from there. But yeah, it's just a lot of people are bullish on that. There's one company that, do we have Paycom in there by any chance in our portfolio,
Not
in our
yet.
model
No.
portfolio?
No.
Yeah, we should definitely look at Paycom, adding Paycom, because I mean I was doing some rule of 40 math on Paycom, and
Yeah.
they're at some of the highest valuations for that, for in terms of like rule of 40, because if you look at their, let me just break down their figures. So if you look at Paycom, right? Paycom's current stock price is about $178, which means they're $10 billion market cap. Their revenue is still growing about 20% year over year, which is going to slow down, but their EBITDA margins like 31%. So that really like is well into the rule of 40. And then if you look at their EV multiple to revenue, it's like 6 times. So it's really low, in terms of like a revenue multiple. So yeah, could be a good pickup.
For the folks that have not seen the Paycom episode that we did, check out Cashflow Chronicles number 44. We talked about it, I guess, 5 or 6 episodes ago.
Yeah.
Chris went through the numbers, and is this one that you have bought into, Chris, or is this one you're going
Yeah.
to DCA into? Okay, you
No,
have.
I have it. I have a position in it. The one that we really missed out on is CrowdStrike, man. That, whew,
Is it?
CrowdStrike's up like almost 100% year over year. That one was like, and the thing is, like, it's such a freaking good company with a great business that you just, I feel like an idiot every time I see the price of. But the thing is, like, I'm running out of cash. I'm
Yeah.
already like fully invested in some really good companies, so I don't think I need to chase these things anymore.
That's the problem, man, is when you're doing this individual stock investing, I mean, you can't catch them all. And
Yeah, it's
um,
like Pokemon. You can't catch them all.
yeah, I mean, it's pretty crazy.
Yeah.
You can't choose them all. Just like crap. What was the other one? Oh, Amit talked about a firm the other day. That's up 240%. Bitcoin's up like 300% or something stupid for the year. For the past year, no, it's only up 130%. But
Only 130%.
yeah, so I mean, it's pretty crazy.
Yeah.
All these different
How,
opportunities.
how did your portfolio do overall this year? I think you're probably up a good amount thanks to your Palantir position, right?
Yeah, I don't know if I have my money spread so far everywhere, but it's definitely looking better. I want to say close to the all-time highs that I had in late 2021, early 2022. And I've just been adding like crazy. So I wouldn't be surprised once we go um, back to all-time highs in the portfolio that, I'll probably be a couple percentage points above that. But I took a big hit in 2022. So building back
Yeah.
from that, is going to be nice because,
Yeah.
well, has been nice because I literally went down a house and now I'm back up a house. So, um, So it's nice. I mean, it's kind
Yeah.
of scary because I think I told you this during the pandemic. I had like 400 grand like in the
Mhm.
market,
Yeah.
and so I lost like I saw that dip into like the high 200s, and
Mhm.
I just knew like this was happening way too fast, and it just didn't make sense. And so I was just converted. Like I was eating in Trinidad, I was like eating peanut and butter and jelly sandwiches, trying to keep as much money as I could, and
Mhm.
luckily I didn't have to pay for rent, a car, nothing. All my money
Yeah.
was being directly put back into the markets because I was living on the company dollar at the time. And so that move from February, March of 2020 to January 2022 was
Mm.
like monumental. Like
Yeah.
every day I was just like, I don't, if you had met me back then, you'd be like hearing me talk about when am I going to buy a Nissan GTR Cash, like all
Mm.
this shit. And it turned out to be pretty good. I mean, to think that I'm still within shooting distance, I'm probably higher now in terms of total invested.
Mhm.
But just from a an individual stock portfolio and 401k, I think I'm a little bit down overall, just because of the 401k. I think I took a little bit out to invest in some of these so that rental property.
Yeah.
So a little bit down on that one just recently, but it's probably still at all time highs. But I don't know. I'd have to
Yeah.
do some looking, but
Yeah.
I'm sitting pretty healthy, man, at 32
Good.
years age. Uh,
Yeah.
if I just even if I were to just let them double and put it in an S&P 500 fund and it doubled a couple times, I
Yeah. But
definitely
in about 10 years, you'd be pretty much set, man. You
yeah.
know, maybe
But that's
that's the
the thing.
option. Maybe
It
that's the goal.
is so that's the thing, Chris. I mean,
Mhm.
that's where I was at about 2-3 years ago. I said
Yeah.
once I got closer to 2020, 2021, I was just like,
Mhm.
I was like, I could literally coast from here, let it double once or twice, and just invest in the dividends. And it's just like that's it, right? Like the
Yeah.
millionaire next door kind of thing, right? You have 2-3 million bucks in the bank and you call it a day, but like who wants just 2 to 3 million? Like to me, like it sounds like a dickish thing to say, right? But when
Yeah.
you're 30, 31 years old and you can be on the precipice of making $30,000 a year in dividends.
Just
It's
don't
kind
make
of
the
like,
mistake of marrying the wrong woman and she taking your
oh no, yeah,
half of your
that's
fucking wins, bro. That's like the biggest thing. Make sure you get a prenup signed. I mean, I have no prenup. I'm at
but
the
you married the
mercy of
rich
my
woman,
wife.
so she's that big fancy doctor. So
Yeah, she's doing well. She's doing well. So,
yeah. Anyway,
yeah.
but yeah, that's where I was just like, you know what? Like I could be that millionaire next door, but it's like I don't want to be the millionaire next door. It's just like I at this rate I could stumble and fall into being the millionaire next door. It's like I want to get to like 8 figures. You know what I mean? I want to get to 10.
Yeah.
I want to get to 12. That's where it gets a lot of fun. So, that's kind of the goal at the moment is hopefully by 50 I get to that point where I'm at 10 12 million.
Yeah.
That's kind of the goal. So
Yeah. All right,
cool.
dude. Well, I'm gonna head out. Ugh.
Oh, you're the man. All right. Well, we
Yep.
have one of my buddies who Hidden Freedom Investing. He retired and now he's back at work, but he's like late 40s, and he agreed to kind of come on tomorrow. So luckily, he'll be. And I'd like to introduce you to him. He knows who you are, so
Mm.
you don't know him, but he's a cool guy. I've streamed with him in the past, and he's kind of been a hiatus, but starting this past Sunday, he started streaming again. So
Yeah.
luckily, we'll be getting him on the show.
Yep.
Cool.
All right,
You're
man.
the man.
Sounds good. Take care.
Talk to you tomorrow. Cheers.
Have a good one. Bye.